thanks everybody for attending. We're just going to give it a few minutes, well, maybe a minute or so, just to let everybody else join. So if you just bear with us for 1 minute or so, just so that we give other people an opportunity.
Okay.
Go for corporate branding.
Do you think? It took me ages to get that right.
It looks good. It looks good.
I had a football stadium behind it, and that didn't look all. It did look a bit odd.
Yeah. Where's this, Tuscany? Did you say?
No, I don't know. I was looking at the screen trying to figure out. Tuscany would be a fine thing.
Well, maybe get back to holidays one day.
No, well, staycations. Hooray!
Staycations, the way forward.
You got the weather, it doesn't matter. I mean, it's great if you get the weather.
Oh, yeah.
The problem is when school finishes and the kids get off, it'll start raining. So
yeah. That's not a very optimistic way to look at it.
The realistic way of it.
Well, even today's lovely. You can't complain at that.
You know, but I mean, last week we had snow. I mean, can you think about it? Can you ever remember a May as bad and as cold?
Oh, well,
because the kids don't have A levels, the kids don't have GCSEs. There's no formal exams, therefore May is terrible. Whereas last year, every other year, it's
you're so skeptical.
I am.
Okay, so that's 11. So we'll kick off now. So thank you everybody for attending what is Toast's first webinar, hopefully first of many. So I thought, given that it's our first one, that we'd be best to explain what Toast actually is. It's nothing to do with breakfast, as you might think, but it actually stands for Totally Online Accounting Services and Taxation. So basically, it's to focus on kind of a modern era of an accountancy practice. It's trying to do away with the traditional way of how accountants actually work. So it's just a modern take on that. So basically, what we are doing is utilizing cloud-based accountancy and giving all of our advice kind of remotely. Now, it is possible to book in-person sessions and things like that if you require them. But essentially, what we've kind of tried to do is fit in amongst your business. So whenever you actually need advice and things like that, that we're there to give it at that stage and use tools which will help you kind of run your business better, get more out of accountancy, and your accountant. So I've used the term cloud-based accountancy. Now, it sounds like a nice term and it's nice and fluffy and modern and tech, but what does it actually mean? So from a business perspective, from a business owner perspective, basically what it allows you to do is store your information centrally. So whether you're on the go, using your mobile or your laptop at home, or a different workstation, or something like that, it means that you can access your information. Now, there's adequate security around it, and it's very, very well protected. It's run by huge firms that provide these services. But what it actually enables you to do is raise an invoice directly to a client. So you can do that with a few clicks on your mobile. That will automatically record that invoice has gone out. And you can then see that invoice has been sent to the client. And when the client actually pays, that will automatically then show that invoice and that client has actually paid you. So it's a very modern way of working, as opposed to, previously you send out an invoice in the post, takes a couple of days to get there, comes back in, potentially get a check maybe 30 days, 60 days later. You have to then go and lodge that in the bank. This kind of works in a more modern way. So if you get a payment through PayPal or a bank transfer or things like that, it'll automatically link in and mark to say, listen, that invoice has been paid. That client is now clear, or whatever the case may be. Additionally, it also means that the reverse is true. So anything that you spend from your business, any expenses, you take a picture of it in your phone, whatever the receipt is for, whether it's for a laptop to run your business, or I don't know, whatever you actually use, say it's Facebook ads or Instagram ads or things like that, they automatically go in. So you're able to see what your business is making on one hand and what you're spending on the other. And obviously, the point of any business is to make sure that one side is higher than the other, to make sure that there's something left for you as the business owner. So it gives you real-time access to that. It makes it easier, more efficient to keep track of your incomings and your.
Can I just say, Michael? Sorry, I was in Cafe Nero yesterday, and I was the lady in front of me ordered a couple of cappuccinos, and she got a receipt, and I actually watched her, socially distanced, obviously, stood back. She got a receipt, and whilst the cappuccinos were being made, I saw her with her phone take a copy of the receipt and upload it to her. I mean, I presume she was using some sort of package like that, but that was an expense, a business expense, because obviously she was sort of meeting with a client, and it was just like that. It was just so easy that it was done. By the time her cappuccinos arrived, that expense had been recorded, and she was on.
Exactly. And then, the other thing is you don't get the receipt and then lose it and kind of go, right, well, where did I actually put that, and all that stuff. You can scrumple up the receipt, get rid of it. That's acknowledged. And
she just bended along with her along with her sugar.
Yeah, and so that's a really good example, really good practical example of how that works so efficiently. And what I was going to say is that how that differs from traditional accounting. So, traditionally you would have had to keep your stack of receipts, make sure everything tallied up, and then, hand over your invoices and your expenses to your accountant maybe in January. As I said, you could maybe cobble them together if you could still find them. And so from that side, it's not really an efficient way of doing things. So the traditional model is kind of, it's essentially the same thing. It's just a more modern way of doing it. So from that side, but what that also enables is that it enables the costs to be a bit lower than what a traditional accountant would choose. So if you hand over a stack of invoices and a stack of receipts, basically in a traditional accounting sense, what they're going to do there is get a member of staff to duplicate exactly what you have. So they're going to total up your invoices sent out, how many were actually paid, how many expenses you had, and that's going to take them, whatever length of time for a year's worth of transactions. And that's really, if a system can do that for you, it saves the cost for it. So it makes sense from that point of view. Not only is it easy and efficient, it makes sense from that point of view. The second thing about Toast is like I said, so the actual advice is what we want to focus on, not keeping track of your incomings and your outgoings. You can do that, as Ronan just gave the example there of your expenses and things like that. What your accountant should be there for is to actually give you practical advice and guidance to improve your business. So ways to save on tax and make improvements to your business. And utilize the modern approaches to how we conduct things. So for instance, if you have a question for us, in a traditional accounting sense, you might have to book a meeting with your accountant, book the day off work because they only work between 9 and 5, go into town, navigate the traffic, park, go into your accountant, ask the question, and it might take 5 or 10 minutes, but it's taken 2 or 3 hours to actually attend that meeting, and it's time you could be spending on your business, or maybe you have another job as well. If you could actually just arrange a Zoom call or ask a question on Slack or whatever way you want to communicate, it's much better use of your time and our time, in all honesty. And we can actually give you the advice, answer the question, and you can move on with the rest of your day. So again, it's using modern tools to give the same level of service, and make sure that we're giving you advice as opposed to paying a member of our staff to total up invoices and total up expenses and go, right, well, here's your profit. And that's all the value that you're getting from your accountant. So really, an accountant should be an advisor, not so much a bookkeeper to how or to keep track of your incomings, your outgoings. And lastly, the thing is to keep it simple and in plain English. So at Toast, we want to make sure that you do actually understand the practicalities, that we're not quoting abbreviations at you that you don't understand, and that after a meeting, you're more confused than when you started. Let us deal with that side of what section of Hmrc's regulations that you have to conform to. We understand that sort of thing. It doesn't mean that you have to understand it as well. All we want to do is to make sure that in a practical sense, you understand what steps and what's required of you as the business owner. And then and let us deal with that sort of thing. Now, we'll keep you right in terms of what the deadlines are and what the key dates are, and Stephen's going to touch on that on a later slide. But basically, those are the 3 things that we think is very, very important from an accounting side and a modern accounting practice. So I'll pass over to Ronan now, who's going to go through some of the 9 things to keep in mind for small businesses. Ronan is our managing partner for his sons. He's been a chartered accountant for quite a while.
A very long time.
Very long time. So nobody better placed to give you advice and things like that. So without further ado, I'll hand over to Ronan. So,
okay, thanks very much. I was going to say, do my Chris Whitty impression there and say, next slide, please.
Next slide.
I think we've had enough of the pandemic at this stage. So, okay, so you're setting up your business. You've decided that maybe you're going to continue working your PAYE job, and you want this to do something else on the side, or maybe that you're decided to make a clean break and just go self-employed and decide that you're going to be your own boss. So there's a number of things that you need to get right. And that's actually before you get to actually, driving the business forward. And I think first things first is actually getting the business name. That seems to be like a straightforward one, but it can be sort of fraught with some difficulties. And I think it's worthwhile taking a little bit of time and doing a little bit of research. And there's a couple of reasons for that. One, there'll be aspects around branding. Now that may be beyond the scope of this session, but you need to think how you're going to go to market. You need to think how you're going to advertise and promote your business. And it can actually be, it's, as it says here, it's a big step, but it can actually be fun. We did come up with the name of Toast for our business, and you're kind of thinking accountants, and trying to come up with a name for, and they came up with Toast, and it was like, well, Toast is straightforward. Toast is understandable. Everyone's familiar with Toast. It's, nice, familiar, sort of buttery sensation, and fills you up in the morning. But in actual fact, it's it actually communicates what we do in terms of totally online accounting services and taxation. So that encompasses the business, and it's that simplicity So, but I mean, you're trying to do it about how you promote your business. You need to be careful around sort of, abbreviations and acronyms. You might have a great trading name, but when people sort of abbreviate it, Daniel's industrial company knowledge, it's obviously going to be abbreviated by people. So whatever you're doing, you need to sort of think at it from different angles. You need to, write it down, look at it, think about it, discuss with other people, family members and friends, bounce it off them, because they might see angles that you don't necessarily see yourself. Quite often you get people harken back to Greek mythology or or historical figures, but it doesn't necessarily, it means something to them. It doesn't necessarily translate readily in today's age.
To your client, to your potential clients.
Correct. What's it gonna mean to them? But one of the things is well is that you need to think. Okay, so you're going to set up yourself as a sole trader initially, but then further down the line you might you might end up incorporating the business, and we'll come back to that. But if you do,
incorporating just means
just setting up, instead of trading as a sole trader, it's becoming a limited company.
Okay.
But so you set up as a sole trader, and you're flying for a couple of years, and you go, do you know what? Now's the time to incorporate the business, and you actually then look on Companies House, and which is effectively the register of all the companies in the UK, or you look at CRO in Ireland, and the name's gone. Somebody else has it, and you're kind of hammered. Then you've been trading on a smaller scale as this, and you're prepared to take that step then to the next level, and in actual fact that the name's gone, so you're back at square one. Sometimes it might not even be, the company might not be trading, it might just somebody's sort of saved the name, and they've got, and that's sort of sitting there, the company's there, it's formed, it's dormant, but you can't get your hands on it. So the other thing is actually when you're thinking about your name is obviously sit down and Google it, okay, and then Google the hell out of it, and I remember a sort of a story that from sort of years back when I was in the States, where they had actually it was a new business startup, and they thought it was a great name and stuff, and then they actually started googling it after they've been trading for a while, and this was in the infancy, if you like, of the internet, but it started sort of coming back with there was a serial killer of a similar name, and so anytime anybody typed it into the search engine, it was coming back with stories about a serial killer, which probably not doing their business much good.
Not the image you want to portray.
No, correct. But the other thing is actually is obviously English is sort of known as the language of business, sort of in many jurisdictions. But in actual fact, say you wanted to trade, and you're trading in France, or you're trading in and if your company name or your trading style or your acronym, any of those, when you abbreviate it down, if it means something different in French or Spanish or Italian, then you can give yourself issues. So that's what I'm saying, like, take your time over getting your business name, Google the hell out of it. You obviously then have branding considerations in how you're going to market. But if at the outset, you need to, you're thinking of your trading style. So it might be your name, but you're trading as, and you can trade as a sole trader. But if you're doing that, you can't try and pass yourself off as a company. There are sort of very sort of stringent obligations around becoming a company, and we'll come on to that a little bit more. But it's what I'm saying is, choosing a name is can be fun, but it can be difficult, and try and do a bit of thinking about it. Take your time, and as I say, research, and do take other people's opinion of it. People that you trust. It's come back to, if you're trying to explain it to grandma and you can't explain it, in 10 words or less, then maybe it's not the right name. but just be very careful as you do that, and obviously as well, just take care that it's not offensive. Okay, next slide, please.
There you go.
Okay, so you've decided then, and you've got your name. You decide what you're doing with your business, be it your to be your main business or your sort of occasional gig or your side hustle, whatever you want to call it. So you then need to think, okay, how am I going to be structured legally? Okay, and this can change as things evolve. And the typical sort of pathway is that somebody may trade as a sole trader initially, and then as the business grows, they then make a decision to trade as a limited company.
Well, I was just actually going to say is that some of the best businesses start as kind of side businesses, and they grow very, very quickly, and then before they know it, they're ending up in a limited company situation with staff and premises and things like that. So
that question, should I set myself up as a limited question, that is if I remember back to my days at university, this is sort of real sort of exam stuff. It's kind of that accounting 101 kind of type question. There's pros, there's advantages to being a sole trader, but there's also disadvantages. And likewise, there's advantages to being set up as a limited company, and there's disadvantages. And there's not necessarily a right answer. It's just, at what particular time do you want to sort of make that move, make that transition? Maybe you have very ambitious plans at the outset and you're fairly confident. Maybe day one is the right time to establish yourself as a limited company.
So just when you're saying sole trader, that's essentially trading in your own name. That's just being Michael Rutherford selling a service or selling a product or whatever. And so the difference then as limited company is that actually it's Michael Rutherford Limited.
Correct.
So it's a separate entity to me.
This is you've kind of really sort of driven me back to my my accounting days at university, because it's actually if you actually look at yourself as a sole trader, you are a person. You're what's known as a corporeal body. There is actually a body, right? A company is known as a non-corporeal body, right? So it's an entity that doesn't actually exist physically. But it doesn't have a body, so as I say, it's a non-corporeal body. But in actual fact, that there's certain key distinctions and there's certain obligations when you become a company. So say if you're setting up by yourself, maybe a sole trader is the way to go. If you're setting up with a friend or colleague or whatever you decide to set up in business, maybe it's a partnership. Maybe that's an alternative way to go. But it really comes down to asking yourself, how quickly are we going to grow? How quickly are we going to generate profits? How quickly are we going to do, what are our future intentions? And you have to try and think that out. Say, for instance, you set up as a sole trader, you're very successful, you generated a lot of profits. Those profits were generated in that year. You then are taxable on those profits in that year, and there's limited scope for you to smooth it out. Say, for instance, and I've just used the example. Say you decided to run a music festival, okay, and in the first year, you made it. Festival's massive success, went like a bomb, and you generated a ton of profits. Okay. The next year, be it COVID, be it rain, be it whatever, it meant the music festival wasn't as successful and it only broke even. So in year one, you generated $500,000 in profits. In year two, you just broke even. Okay. You got in your first year you get taxed on that 500,000, and then in the second year, you don't have that same scope, if you know what I mean. You don't have any profits to tax, but you've already had to pay over a lot of that tax. Whereas in actual fact, if what you had done is set up as a limited company, you could have you'd have paid some corporation tax, you'd have taken your salary or your dividends out of the company, but you could have left some in the second year. You could have taken your salary and dividends, despite the fact that it's broken even. So it's just about that question about the level of profits that you're likely to generate as a sole trader or as a limited company. And a limited company allows more flexibility.
So essentially, in that situation, as a sole trader, you would have had to take the 500,000 in that year, regardless. Whereas if you were set up as a limited company, you could have taken a salary of, say, I don't know, 50,000, 40,000 in year one, and then you can still pay yourself in year two and take a similar salary or whatever. So you can have the flexibility to control how the money comes out.
Yeah, and that
as a sole trader, you don't.
Yes, correct.
Okay.
So it's that lack of flexibility that for some people makes them think that maybe a limited company is the right option. But maybe if it is kind of the music festivals, maybe it's they tend to have a life cycle all of their own. Maybe it only runs for a couple of years, so maybe at the end of it, the intention is to run the music festival for 5 years. And then at the end, they've built up a pot of cash in the company that runs the music festival. But how do you then take that, get access to that funds? Again, being a company set up in a limited company structure allows more flexibility in terms of how they can take the profits generated. So that's what we're coming back to, sort of the question there. We're saying, is it your intention to sell the business, or how do you intend to, do you intend to gift the business to a family member or so forth? There are sort of a number of issues. For many people, being self-employed is fine, but it just is a matter of scale and flexibility. If you're self-employed and you also have an employed income, typically what you'll do is your job, your PAYE job, you'll pay your taxes on that. You'll get your P60, and then that is used as the basis for your self-assessment, your income tax return, whereby you put, you add in the details from your P60 and then your self-employed details on top, and you pay the tax accordingly. But it's just, I think it's less flexibility, as a self-employed, because, as I say, you don't have that ability to smooth your income, so to speak. But it really, that's only part of the answer, part of the solution, if you like. If you move on to the next slide, Michael. As a sole trader, yeah, you're the boss. You keep all the profits, but as I say, that if the profits are up and down, it can sort of cause difficulties in that you have big tax liabilities one year, none the next, big tax, and so forth. So it's just trickier in terms of cash flows. Anyone can sort of set up a business, and as a sole trader, startup costs are low, and quite often this is the first step. People dip their toe and then they see how it works out, and then they consider maybe incorporating, or as in becoming a limited company at a later stage. What you do have to be careful for is that as a sole trader, you're personally liable for all the debts. A limited company has limited liability. So there's a couple of exceptions to that, and I'll come back to that. And some it says there that being a limited company has more prestige. Some companies only really want to deal with other companies, if you know what I mean. They don't necessarily want sole traders, because it's a kind of perception thing that there's more substance to a company, and there's more standing behind that business if it's a limited company. Now, It may be that that's not the case, but in actual fact, they just that it's just that perception.
Yeah. Just when you're saying that they're personally liable for the debts, that means, so if, say, for instance, you're taking on a premises and you're signing the lease and something doesn't go right or doesn't go as you planned, that's kind of meaning that person then owes the rest of that lease or whatever. So it is an important, very important factor when you're deciding to set up a space. If you're starting something up from the house and there's no the setup costs are low and you're not having to sign anything, that's where we're saying it's okay. But it's where you're actually taking on loans or leases or things like that maybe you should give consideration to a limited company.
Correct. There's a little bit of a proviso in that quite often when companies are in their early stages, that a HP provider, if you're taking a vehicle or something, the HB company, the hire purchase company, may want a personal guarantee anyway. Quite often banks want personal guarantees. So even within the limited company, you may be personally liable for some debts, but you can manage that, and generally you can mitigate it. However, trading as a sole trader, there's no scope to manage that. You are liable for all the debts.
So I think really it would be advisable before you actually sign anything to make sure that you either speak to your accountant about it and just kind of say, look, is this okay? Is there anything I should be thinking of differently here?
If you think about it, you're actually putting, a company has its own assets and liabilities, and they're sort of, demarcated. They're ring fenced effectively for that company. But if you're, trading as a sole trader, you're potentially exposing all your assets, your house, in your car and so forth, all any savings you have, you're potentially exposing those, because those assets, as a sole trader, there's not the same sort of ring fenced aspect of it. So that's really what we're saying.
So it's really down to the specific circumstances will determine which way you should go.
Yeah, and I think then it can be difficult, as I say, raising finance as a sole trader, and investment can be very messy, because what does the investor actually hold? So a limited company is a much more sort of well-worn path in that respect. In terms of income tax, and that is, if you generate a lot of profits, then you're potentially due to pay sort of 40 or 45% income tax on those taxable profits. Now, in a company, the corporation tax is currently 19%. However, so that's what I'm saying, that you can pay a tax on that profits, and then you can leave the money in the company. If you take it out, obviously it'll be taxable in your hands as an individual, but you could reinvest it. You can you can leave it sort of sitting there and build it up, and potentially at a later date take it out as a capital gain, which is lower than income tax. So there's various things that you can do, and I think that is possibly one of the most, you can think of some of the things for the question between sole trader, limited company, really comes down to his various commercial considerations and some taxation considerations. And I think it's the taxation considerations that quite often seem more compelling to people. Okay.
Just one question before, because it's somewhat related to this topic. So somebody's asked, can I do my own self-assessment tax return?
Yes is the answer. If you speak to Hmrc, they're convinced that it's incredibly easy and that no one needs an accountant. However, the truth of the matter is that it is actually, I would just really caution against it, because I had a case recently where an individual was the revenue were petitioning for his bankruptcy, and when we actually looked at it, he had been submitting his effectively his revenue as his turnover, his revenue, as his profits, rather than taking off the expenses against it. So, I mean, the very nice individual, but he just messed up on a sort of relatively simple aspect of it. And whilst the revenue had sympathy for him, they were still petitioning for his bankruptcy. So the answer is yes, you can. However, it's fraught with difficulties, and it's, for most people, it's not something really that they should be worrying about. Worry about driving your business forward, and let somebody else worry about staying compliant with Hmrc. Hmrc
When
maintain
you're
a
used to dealing with them, it's a bit
yeah
easier. It can
yeah
be very
and
scary on your own.
yeah, exactly. I mean,
And you don't want
they actually
penalties or anything, eh?
no,
Yeah, that's
interest and
true.
penalties can be costly, but they do maintain a fighting fund to go after what they perceive as sort of naughty boys and girls, so people who aren't compliant. I think the fighting fund that they maintain is about £12 million. So, but it's that they're going after people that they feel are not being compliant. And you can try your best and still end up on the wrong side of the compliance requirements, and you end up, as Stephen says, with interest and penalties, and it does get
It's just a genuine mistake.
it can spiral out of control. So yes, you can. However, give it serious consideration to having a professional, do it for you. It's not that expensive, to be honest.
So we have another question just again before we move on. So somebody's asked if we can give any advice on trading profits from cryptocurrencies. As I have a second business which is online trading and unsure of how this works. Actually, it's a very, very complicated question because it really depends on how you're actually trading the cryptos. If it's through things like CFDs, then Hmrc consider that gambling, and it is not taxable. Whereas if you're buying an asset and if you're buying a cryptocurrency and holding it, it can be taken as a capital gains tax, which Ronan's just kind of gone through. There's different bands of taxes, and that can be done that way. If you're going in and out of the cryptocurrency within the day, then they can consider that income tax. So, yeah. But there's very, very, very specific guidance, and it's actually more towards kind of cases that they've taken against day traders, and kind of it's more law based than regulation based. So it really depends on how you're actually doing that.
It depends. It really comes down to the trading versus investment is always it's a perennial question. If you buy something to hold it, it's maybe subject to a capital gain, which is generally lower than income taxes. Now we did have one where somebody took a payment in crypto, and they it was for a relatively small assignment that they'd done, and I think they were charging £1,000 or whatever, and they took the crypto. So at that point they declared that £1,000. In the meantime, obviously, as we're well aware, some of the cryptos have gone sort of through the roof, and so they it wasn't too long before that £1,000 of crypto that they took was actually I think it was about 12,000 at a point. So they had held that. So that it's then a discussion for, okay, you got paid in, if the analogy is if you had actually get paid in, say, US dollars and sat on the US dollars, and then sterling had collapsed against the dollar, you're then sitting on something which is conceivably worth a lot more. So you pay income tax on a portion of it, and then later on, when you actually dispose of it, you're crystallizing a gain. But that's sort of different from that. That's not really somebody who was in a trading scenario that Michael was talking about.
Yeah. So it's a very specific question, and look, we certainly we can give advice on it, but as I said, we kind of need to understand exactly what you're actually doing there. But very good question, then.
And how you're doing it. So,
Yeah.
okay, next slide, please. I'm getting used to this actually.
Not even
Yeah.
have to turn over your own slides.
Okay, so if you we're coming back to that. You set up a separate entity, so it's not you anymore. It's a separate limited liability. The business is, if you like, I think maybe not demarcated, but it's actually, there's a border between you and the business. So you're not personally liable, except where you sign a PG, and a PG is personal guarantee. So the bank, and you might approach the bank, and you want an overdraft facility initially, and they say, well, they'll give you one, but they want a PG. So effectively, you're waiving that limited liability of the company in respect of that liability only. And as we said there, it can sound better, professional, image. Now there are certain professions that can't necessarily trade as a limited company. It used to be that accountants couldn't trade as a limited company. I think barristers and I think sort of certain NHS doctors are precluded from trading as a limited company. But then as well, once you've set up the company, you've gone to company's house, you've checked that the name's available, you've bought the name, that name is then yours. So it protects, your business in that respect, and no one else can, register that name. Now there is a thing called passing off, where they might be sort of trying to have a name similar to, so as to suggest that well, that's a legal matter for a different day, but by and large, your name is then protected. The flip side, however, and it's really coming down to the disadvantages are, there's more, or there's additional requirements, and if you have set up a company and you're your own boss, effectively, you're becoming the company director. Now, if you're a company director, there are various statutory obligations placed upon you. The obligations to file returns with Companies House, the obligations to file tax returns with Hmrc, etc. And those obligations are, as I said, they're statutory obligations, but there's also fiduciary, which is a duty of care. There's fiduciary duties that are placed upon you as a director. This really seems peculiar, because you've set up a company. The shares, you say own all the shares in the company, and then you're acting as a director. So effectively, you are the shareholder on the one hand, but you're the director on the other, and you have to do everything as a director for the benefit of those shareholders. Now, it may be that you then, that you take on board an investor. So say or a partner that you've previously that you've decided to incorporate, and you own the business 50-50. That fiduciary duty is that duty of care is owed to all the shareholders, not just your shareholding. Okay.
You basically have to do what's right for them as well as yourself, because they're co-owners in the business. Is that essentially?
Yeah, and it might be that it might lead to resentment. Say you have somebody who initially is as a partner, and then they kind of go and do their own gigs and own side things, and they end up as not really involved in the business, but they're still a 50% shareholder. You have to do everything for their benefit, because they're a shareholder. So
just one question that's really relevant to this. Somebody's asked, I've set up a company, but there's little trade in it. Do I still have to file company accounts?
The technical answer is yes, you do. If you've set up a business and you're not yet trading, you can file dormant accounts. So if you're starting to do the setup bits of it, but maybe you've got distracted, and you're doing other things, and it's taking a bit longer, and you've got no trade going through the company, or you know,
No income.
no income going through it effectively. You can file dormant accounts because the company isn't active. When you start to become active, despite the fact that it's only limited activity, then you at that stage you do start to need to file annual return on accounts. Okay.
Good. Yep.
Yeah, you do actually see people that do that for sample name protection as well.
Yeah.
Just so they protect the name. You don't have to trade through it, but the name is protected in that way.
Yeah.
So that's what I was saying, is that when you're set up as a sole trader, you might give some thought to actually just buying the company name anyway. It'll be, it's relatively cheaply done, and it, as Stephen says, it protects that in that respect. Next slide, please.
Oh, sorry.
As I said, as we were sort of talking previously about the two aspects of it, there's the commercial considerations versus the taxation considerations. If you're sole trader, all your taxable profits in that year are taxed on, as income. If you are in a limited company, you pay obviously the corporation tax, which is lower. But then whatever you could do over the next number of years, you can draw a salary, and potentially that it keeps it at saves in national insurance costs, saves on income tax, etc. But you can also pay dividends, so declare a dividend out of retained profits, and it allows that flexibility. So maybe that you have a great year and the company's flush with cash, but then the next year the trading's not great, but you still need your salary, and you still need to draw dividends. You can do that. It allows that, as I say, that flexibility. If you've made the profits, you can distribute them. Okay.
Just in relation to that, somebody's asked a question: how do I actually work out my business profits?
Business profits is basically you're taking your revenue or your turnover. So pretty much everything you invoice is your turnover. And that then you're allowed to take off various expenses. Now, not all expenses, but you have to take off allowable expenses. And if you have your turnover or your revenue, effectively your sales, less your allowable expenses, you then calculate your business profits or your taxable profits. Now, I'll come back to just briefly what is allowable. For an expense to be allowable, it has to be wholly and exclusively for the purpose of the trade.
So this is your Hmrc's definition of what is wholly and exclusively.
So this really comes down to, say you're a social media influencer, and you've decided to go off to Dubai. Quite topical, I understand. You decide to go off to Dubai because you're doing photo shoots for whatever clothing lines that you're helping promote, but you decide to bring your partner, not your business partner. You decide to bring your partner with you, and sort of you book the travel for you and your partner. That runs the risk of being excluded, being wholly excludable, because it's not wholly and exclusively for the purposes of trade. You're bringing your partner not for any work reasons. You're bringing your partner. They're coming out for a holiday or a jolly, effectively, socially distant and COVID appropriate, obviously. But they are, they're coming out. It's not for the purposes of trade, and there have been cases in the past where people have, they've been going to a conference in the States and decided to bring their spouse, and then the revenue has just excluded the whole lot of it. Now, say for instance, so going back to that social influencer going to Dubai, they are going to Dubai. Their partner, however, is heavily involved in the business and tends to take all their photographs and do their social media, sort of a lot of their social media posting. So in fact, that you have two people who are heavily involved in the business, who are necessary for the business. So that then expense is conceivably, they're allowable because it's wholly and exclusively for the purposes of the trade. So it's something you got to be careful around, but you got to be sensible to what the expenses that you're trying to claim, because the revenue obviously do look at this. This points back to your question earlier about should you do your own self-assessment. If you have any doubts around what the types of expenses that you're claiming, then it's best to get advice on it, because what happens is basically the revenue exclude it, add it back, and charge you more tax.
Yeah. Oh, that's good. Sorry.
Okay. Sorry, then it's mentioned there about the national insurance, but also the pension contributions from a company. Effectively, the company is making pension contributions on your behalf, but it's allowable tax deductible in respect of the company.
It's a good way to get income out of a business that particularly you're doing well, and you're growing. It might be later stages for some people, but it is a good way of getting tax-free cash out of the business.
I know what you mean. The other thing then is that if you, as I said, if you're a sole trader and you've decided that you've grown the business and you want to sell up, at what point, or what exactly are you selling? Because there's no legal entity, there's no, and it's not, it's kind of messy, because it's like, oh, I'm selling my business, but these assets are my assets, those assets are the company or the business assets, and so forth. With a company, effectively you're selling shares, and that share, they can, whoever's acquiring the business, they acquire the shares and title to all those company assets. So disposals or any of those sort of acquisition transactions are much easier in respect of a company than it's fraught with difficulty if you're a sole trader. Yep.
Well, just one question. So I started my company in September. How soon should I find an accountant for taxes next year?
I think soon. I think the sooner the better, because of what you can, they will advise is about sort of effectively planning. So the sooner you get somebody on board, the better, because then they'll plan and help advise you in terms of, look, this is the deadline dates, this is what you're going to need to provide, this is what you're going to need to effectively financially to put aside to pay for those tax liabilities. So the sooner the better is really just the answer in that respect.
There's more guidance from Hmrc on it, and specific deadlines as to when you have to register for those kind of things, but we'll touch on it on one of the later slides in terms of the deadlines and stuff, and when things have to be registered with Hmrc by. But
so I think, say for instance, if somebody started a business and then they come to us, it'll take a period of time for us to kind of, we'll have to go back for the previous kind of trading period to kind of total everything up and make sure everything's in order. So it can be a bit more difficult to unravel that at a later stage. Whereas if you're doing it kind of as you're ticking along, it's probably much easier to keep track of. And things like what Ronan was kind of suggesting earlier is that we can advise on certain expenses as you go along that potentially you're not really thinking are related to the business that you have, but actually when you actually look at it, the fact that your partner does assist you as part of the business or things like that can make a difference to what expenses that you should actually be keeping track of. So there's certain bits of advice. So the sooner the better is twofold, in the sense that it's much easier to keep track of things as you go along. And secondly, it means that you can actually kind of get advice and kind of reduce your overall tax bill as you go along with the correct advice around expenses and things like that. So
I also sort of think that advice and expenses that I mean, a lot of people with the pandemic have been working from home, so there's various expenses in respect of working from home, that things you might not necessarily have considered. So it's just that things that we know that are sort of tried and tested and sort of dealing with the revenue, and so it's making sure you're mitigating your tax exposure there as well.
So you're referring to use of home as office and things like that. So you can actually get a tax deduction for the fact that your office might be based in your home, and that's what you work for, and things like that. So, I mean, it's things like that it goes back to that. Can you do your own self-assessment return? Yes, you can, but it might mean that you end up paying more tax than maybe you should be, and that sort of thing. So.
It actually comes back to Michael. Is sort of I do remember there's an old partner in a firm I used to work for, when he was asked about, could you do your self-assessment returns, and he said, well, I like to think, could you service your car annually? He said, technically you could, but the question is, should you? So,
that's a very good way to put it. Actually, that's
the
other thing is the time it would take you.
Yeah.
Well, not to service your car, but to do your self-assessment.
Yeah, it can take me an awful long time to service my car. So, so the one thing about companies, however, is that they're on the company's register. They're and you submit returns, etc., to the company's house. So effectively, you're opening that, this is the quid pro quo, if you like. So people are saying, okay, you've got limited liability, but to afford you that limited liability, you have to provide people who maybe become your creditors a bit more information. So you provide them with a company's house with more information, and then they can make a decision about whether or not to trade with you. So, but it does mean that it's not necessarily confidential, because your home address is going to be your occupation, etc. Your details as a director would be attached to the company.
And people can search that public register for you and see how that company is doing. So if you want to keep it very quiet, and the fact that you have potentially quite a bit of money or quite a bit of money going through the company, might be possible for other people to see that.
Yeah. So, but I mean, there's things that you can and cannot do. But again, you take advice. You could be a non-limited company, but that's a whole other day. Next slide, please. I think this is my hand over to you, Stephen, at this point, or am I doing this one?
Yeah, no, this one. I'll do from the bank account onwards, I think it is.
All right, okay. So you've decided then you want to go sole trader, or you've decided that you want to incorporate. Any which way, whatever vehicle or whatever mechanism you are going to set up your business and trade. You've chosen your business name. Effectively, you need to register with Hmrc, as effectively you're saying, look, I'm registering as a sole trader, so I'm I'm going to be liable for self-assessment, and I'm going to have to submit my self-assessment returns. So once you register with Hmrc, they give you what's called a UTR. And that's used in all your dealings with them thereafter. And that's the same actually in a company. Obviously there'll be a company number, but they get a UTR as well. So it's just fairly straightforward. But at the earliest point, there's no point in trading for sort of 12 months and then sort of going to the revenue and say, no, actually I set up my business. At the earliest juncture, you need to set up your dealings with the revenue.
Just one question related to this. So somebody has a full-time job, but also have a self-employed job on the side, so a bit of side income. Can I do both, and how does this impact my tax return?
Of course you can. From it really comes down to you and your employer. If provided it's not, you're not going to get fired for doing it. You're not. But you have effectively what you do. Your employer every year will give you a P60. That P60 will have all your earnings that you've dealt with under PAYE, and that then forms the basis of your your self-assessment returns. So you fill in those details on your self-assessment returns, and that effectively uses up your tax, personal allowances. However, you then, whatever your trading profits are from your self-employment business, they also then go into the returns, and they are taxable. Now, you can't claim the personal allowance again because it's already been used up in your PAYE job. But you can certainly, it's increasingly common these days that people have PAYE income and self-employed income on top of it from their side venture.
So just to kind of to clarify 2 points there, the personal allowance is basically how much you're allowed to earn tax-free, and as Ronan said, most of that is usually consumed by your job. So it depends on what you earn in your existing job. One thing to kind of make clear as well, it depends really on the extent of your side hustle or your side business. If you're taking about less than £1,000 from it, if you're turning over less than £1,000 from it, then there might not be any requirement at all. So you can just do it alongside, and then but it really depends on your circumstances. So again, before you kind of say, oh no, listen, I'm fine, I don't have to do anything, I would get advice. It's why we do free consultations and things like that. The reassurance that it gives you in terms of, yeah, I know that I'm doing everything right, as opposed to sitting awake at night thinking, I wonder if HMRC ever going to come after me for what I'm doing on the side. It's just that reassurance. It's free. It's a free consultation. So that's really what we would encourage, is that just, if you need an accountant, okay, that's doable. It's not really complicated to do, but it might be that we just turn around and say, listen, it's a side business, and actually you're fine. Just continue on as you are. You don't have any obligations. So it really depends on your circumstances, and again, it's maybe getting advice.
Yeah, definitely. Okay. Right. Next slide.
Is it just the same, but just with the company structure?
Exactly the same for the company. There's a couple of other steps. Now, you can have an agent do this, or you can do it yourself. But effectively, the company name, you're checking that it's available, and then you buy it and reserve it, and effectively then you have to provide details around who are the directors and who are the shareholders. And then there's what's termed a memorandum and articles of association. These are basically the governance aspects of how a company is run and managed. You can typically adopt sort of standard, sort of what's called Table A, memo and articles, and that's, hey presto, you're in business. But you need the revenue will be in touch as well.
Yeah. So that's really good. Okay, so I think we'll pass over to.
There's the VAT
one word.
Oh, okay. So the final aspect that I think I'm gonna talk about is VAT. VAT is it's value added tax. It can be a minefield. It can be very, very complicated. For most people, it's like they just know it's like, oh, they have to add on extra, on top of whatever their the quoted amount is. But in actual fact, if you're trading and you're below what's called the VAT threshold, then which is £85,000 in any given year, then you don't need to register for VAT. But the VAT that you pay is effectively a cost to your business. If you think at any stage that you're going to trip that threshold, then you need to be able to, you need to be looking at registering with Hmrc for VAT purposes. And if you do, you then are subject to doing periodic VAT returns. And if you do that, you can claim back an element of the VAT that you've incurred. But it's another sort of compliance headache that arises that you need to one, you need to be very aware of it, and two, that you need to sort of get appropriate advice at the appropriate time.
Yeah. So basically, it's a consideration when you're turning over quite a bit, maybe. So it's about 7,000 a month or something in that kind of region. So, as Ronan said, it's just something you need to be aware of. It's not, it's just a procedure that has to be done. You charge it on what you sell, and you can recover it on things that you buy. So they kind of go against each other. But it is something that you need to be aware of. If your business starts doing particularly well, it may be that you hit that VAT threshold and you have to start looking after it. So
I remember sort of speaking to, now he wasn't a client of ours, but I remember speaking to an individual who, he'd set up his business. He traded, and the VAT threshold was slightly lower than that, but he traded for about 4 or 5 years, nowhere near the VAT threshold, and never really worried about it. And then he got bigger, got a couple of big contracts, a couple of big jobs, and hey presto, he was well over the VAT threshold. But he just, because he'd always ignored VAT, he'd ignored it, and then it stored up a lot of problems for him, because he traded for over a year, and he was well over the VAT thresholds. So he should have been alive to it. He should have been aware of it, but he wasn't, because he got into that. Well, it's
kind of comes back to the zero thing, where if you have real-time information in terms of what you're turning over and what your expenses are, then it'll kind of trigger in your head that, okay, I might be near the VAT threshold here. So that's basically another reason why kind of cloud accounting is so useful in that sense. So I think that's Ronan completed. I think he's frozen just now, which is unfortunate, but it was just as well he's finished. So I'm going to hand over to Stephen now, our second panelist, who's going to discuss about kind of practical steps of what actual cloud accounting means. So Stephen's chartered accountant and head of kind of our client side operations, who looks after all of the client advice, making sure that they're that they're well served and that they're keeping right. But basically, it's to go through practical steps now. So Stephen, over to you.
Hi everyone. Yeah, so look, Ronan's been over everything in terms of the legal side of it, choosing your name, and then the structure. So now I'm going to focus on the kind of the day-to-day operations of the business and how you run it on a day-to-day basis. Now, one of the most commonly asked things is, do you need to have a business bank account for your business? Now, it's slightly different for either a sole trader or a limited company, but either way, with regards to a business bank account, it's probably something you're going to want to have to do pretty early on. If you haven't done so already, then looking into setting up a business bank account is always going to be wise. I mean, if you're looking at, you're in business obviously to make a bit of money, so you want to have somewhere where that money is going to be going to at the end of the day. And by having a business bank account, it makes things a lot easier. But the question is, do you actually need to open up a business bank account? It's different for both the limited company side of things. Like Ronan touched on earlier, the limited company is pretty much seen as a separate person. It's a separate legal entity. Therefore, it's more advisable, and you'll hear more of it. If you get further advice from anyone or you see it online, they do advise to set up a separate bank account for a limited company, because everything is separate. So from a limited company perspective, yes, it's more advisable to set up one. From a sole trader perspective, it's slightly different for a self-employed individual. First of all, I mean, there's no legal requirement or guidance from Hmrc to say that you need to have a business bank account. So can you use your personal account? I mean, the simple answer is yes, you can. But I mean, we would strongly kind of advise that it's wise to set up your own business bank account, and mainly for the reasons here that we've outlined on the slide. Now, this is only a couple of them, but they're kind of the most important ones with setting up your own business bank account. First of all, look, it helps to simplify your tax return. Now, what we touched on earlier was, look, traditionally what would happen is your tax return is due to be filed, and your accountant would request information for your tax year. So you'll be compiling a list of the sales you've made, the invoices, all your expenses, but also your bank statements. So you'll issue 12 months worth of bank statements for your accountant or your bookkeeper to go over and to ultimately file your tax return. Now, if you're running your business through a personal bank account, I mean, you can imagine the kind of transactions that are going to be seen on that account, both from a personal and a business perspective, and how hard it would actually be to separate both of them. And not only that, it can take a lot of time to separate both of them, but you're hindering yourself from a tax perspective also. I mean, you could have transactions that's running through your personal account that are actually business related, but you weren't sure at that time, is this business related or is this a personal expense? So you could be kind of crippling yourself, and that you could be losing out on a number of expenses that could potentially reduce your tax when you've actually classed them as personal. So that's one of the main benefits of actually separating it from a business perspective to a personal account. Keeping them both separate, it's going to make things a lot easier. And in terms of the accurate and clear bookkeeping side of it, we'll touch on it in a second when we get to the software side of it and how the actual bookkeeping side works. And then those other final two, it makes you look a bit more professional, and it helps build your credit rating. If further down the line you need kind of further funds or assistance from anyone, then having your own separate bank account will help in that respect.
Is it fair to say that it's kind of the first thing that you would advise a client to do?
Yeah.
Is that
always the first thing? I mean, the ones that I've spoken to, it's one of the first questions, and even the first question that I'm asked is, do I need to have a business bank account? And yeah, we would always advise yes. It's always wise to set up one for obviously the benefits that brings with it in comparison to having it run through your personal account. There's just so many uncertainties with it, and it's just so hard to keep track of.
Okay, that's good.
Yeah, next slide, Michael.
Sure.
Now, the next most important thing, and there's more kind of guidance from Hmrc on this. With a bank account, like I said, they're not really saying, yeah, there's a legal requirement to set up a business bank account. With the record side of it, Hmrc do state that you must keep records of everything you earn, both from a limited company perspective and a sole trader perspective. They're pretty much the same in terms of the records that you need to keep. And they tie in with what Ronan was saying and Michael was saying about the wholly and exclusively side of things. So as long as it's business related, then you need to keep records of it. From a sole trader side of it, you also need to keep the personal income. So if you do have any other sources of income, whether it's a PAYE full-time job, or if there is any other sources of income, you must keep records of that also. Because when it comes to filing your tax return, they're all bundled into that tax return, and your tax is calculated that way. There is slight differences on it from a limited company side of it. You can see there that you need to keep records about the company itself, the directors, the shareholders, and any loans or anything that you have secured against assets. Every year you'll have to file a form with Hmrc, a confirmation statement is actually called, with as a limited company, and that's basically just to let Hmrc know that everything, it's fine. It's the same shareholders. Nothing's really changed in the last 12 months. So those are the kind of records that you will need to keep and inform Hmrc of.
But it's fair to say, though, I think this looks like it's quite a big requirement. But actually, it with kind of the cloud-based things, it's actually fairly straightforward to keep track of.
It's easy, straightforward. I mean, Hmrc kind of boldly state that you could be fined up to £3,000 by Hmrc if you don't keep records of your accounting. If you don't keep your accounting records, so it's very, very important. But the good thing now with the cloud accounting software, it's very easy and it's very, very simple to keep track of them. Yeah. The only other slight difference between the both of them is the length of time that you need to keep the records for. As a sole trader, you need to keep your records for 5 years. And as a limited company, it's an extra year of 6 years. So as you can imagine, traditionally, what you would see is that if you're keeping 5 years of records, you can imagine if you're keeping hard copies of those at home, or whether or not your accountant's keeping these copies in their office, it's 5 years of files. It's built up. there's a good chance you're going to lose out in some of those records. They're going to be either misplaced at home. There's going to be general wear and tear on these invoices that are going to be hard to read. So if Hmrc come knocking, in the event that they have an investigation into your affairs and they're saying, look, okay, we want your records from a couple of years back, trying to get those records together is going to be pretty hard. But the good thing now with the accounting software is, I mean, they're all digitally kept. They're all kept and stored in a one secure place. So it's easy for you then to go back and say, well, look, here's all this information now. And then you can just send it off. And it kind of limits any potential that you would have of being hit with fines by Hmrc for not having adequate records. So yeah, record keeping's key, but it's a lot easier now with the cloud accounting software.
So it's much easier to go onto your cloud accounting software and select the particular year.
Yeah, exactly.
And just extract all the invoices and there you have it. It's a couple of clicks, as opposed to trying to root through maybe a filing cabinet or something
or a shoebox, or
shoeboxes, yeah. Okay, no, that's good.
Good.
Next one. Okay, so this is the real stuff.
This is the stuff that we work with on a daily basis, and then stuff that we recommend all clients to work with, simply because of the many benefits that it brings. Now, the three, I'm going to focus on a couple of ones here because they specifically tie into what we just discussed in terms of the bank account, but also the accounting records. The first one there with the cloud accounting software and the benefits of the bank feeds. So like we touched on, traditionally you would send hard copies or email across copies of your bank statements to your accountant, who will look over everything for that period. Now, with the bank feeds, what you can actually do with your business bank account is you can link your business bank account to the Xero software package. And what happens then, it's daily income feeds in to the software package. Every transaction, so everything with regards to your income and purchases flows straight in from the bank account to the software, and then you can reconcile it every single day. So, or every day or every week, wherever you prefer to do, rather than coming at the end of the year and you're having to sift through 12 months worth of information and forgetting, look, I don't know what this actually related to. It's easier now to do it. You know, if you're doing it every week, you say, yeah, okay, this was related to income, but it also ties in then with creating your own invoices and stuff. Everything kind of integrates with one another. So if you're creating an invoice, I know Michael touched on it at the beginning. If you're creating an invoice from the software package, you're sending it to a client. Once you receive payment into your bank account, the good thing with the software is it automatically matches up what was on that invoice to what was received in the bank account. And then it's just a matter of clicking a button to say, yeah, this is what it relates to. It's a match. It's automatically reconciled in one area. And that's it, done. You don't have to worry about it again. The invoice is stored online. There's a record of it there, and your accounts are actually reconciled as you go along. And then at the end of the year, then it's a straightforward procedure. You have a profit and loss after everything is reconciled. You know exactly what your profits are. And then we can then look at, okay, so you spent this much on this expenditure. What advice can we give then as to how we can potentially reduce your tax liability? And then filing the tax return in a timely and efficient manner as well.
Well, it actually shows you dashboards and things like that, doesn't it?
The first thing you'll
see how much you've invoiced and how much you've been paid and what you're spending. So it's month to month. You can see how you're actually getting on. Yeah.
So what you'll see, I mean, you have a subscription to it. You log in. The first thing you're going to see is the dashboard. And on that dashboard, you're pretty much going to see the financial performance of your business. So you're going to see the total cash that's coming in and out. You're going to see what your bank balances are. You're going to see what invoices that are due to you are, what money is actually owed to, what has been paid. And then the same with what actually money you owe out. So if you have any suppliers that you're having to pay money to, or and all those kind of things, it's all there on the one dashboard. It's easy to navigate. And like it says there, you can see your financial position at any time. It's updated daily. So you'll on the go, if you're out and about, if you're meeting with a client, even if you're meeting with your accountant can kind of collaborate with you on that. You can both see it in real-time information. traditionally what would happen is, if you want to meet your accountant, you'd have to organize a meeting. Your accountant would have to print out pages of how you've done the past, and then you're kind of having to, rather than, yeah, I can see it now on my phone, you can see it as well, and then you can kind of discuss and give advice as you go, rather than having to kind of waste time and studying what's actually happened in the last 12 months.
And like you said, in terms of advice side, it can be useful in the sense that the it might not feel like you're spending a particular amount on a particular thing. So for instance, you're not aware that a certain thing is costing you so much. And then if you're seeing that on a monthly basis, you can kind of go, right, well, I need to kind of reduce how much we're spending there, because it's too high. So from that side of running your business, it makes it much easier to spot that something's potentially higher than what it should be, and it means that your chances of survival and profits, which is the whole point of the thing, is much easier to get to if you have it real time. As Stephen kind of said there, traditionally you might have gotten a set of accounts one year, you looked at them and kind of went, well, okay, that's not what I expected. It's not really day-to-day operations of the business, whereas accountancy really should be that. It should be advice as you go along, and kind of picking up wee bits and pieces here and there where you can make improvements and things like that. So it's really useful from that perspective.
Yeah, and I mean, look, what sometimes you might see with other accountants is that you might only speak to them once a year. They'll request your information at the end of the year to file your tax return. That's it filed. You'll come back to them again the next year. Whereas with this, it's kind of aimed at kind of constantly kind of engaging and becoming more of a kind of a business partner in a way, in that you're giving them more advice and to kind of build and grow and getting everything accurate from the get-go, rather than kind of speaking to them once a year and then you're kind of having to go back over stuff. So yeah, it's a much better from that perspective. And then look, the other things here I want to touch on is that point there with regards to the ability to scan receipts with a smartphone or a tablet. Now, Michael did mention it at the start, and Ronan actually mentioned it when he was in the coffee shop and kind of seen the girl taking a photo of the receipt. I mean, that's pretty much what it boils down to. It's straightforward in that, if you are out and about, no matter what the receipt is for, take a quick picture of it. I mean, someone once said, and Michael was there, the guy said, I mean, if you can take a selfie, you can take a photo of a receipt, kind of thing. And now, especially with social media and how and everyone running their business from a social media platform, I mean, you're constantly taking photos of your work and kind of publishing everything, getting yourself out there. And the same should go when it comes to recording your expenses. There's great apps and software there that you can take a quick picture of that receipt. It's done and dusted in a couple of seconds, and then that's it. It's all recorded on a software package and it's all reconciled, done and dusted. You don't have to keep the hard copy of it. It's stored there online. So that's another benefit of it. The final one then that I want to touch on here. Now, the others are pretty straightforward. Sorry, Michael, could you just go back to the previous one there?
Oh, sorry.
It's focusing on this Making Tax Digital that Hmrc have rolled out, and it's kind of how cloud accounting software and where everything is going. Hmrc rolled out the Making Tax Digital to make things easier for individuals and businesses to get their tax right and to stay on top of it from the get-go. Now, it's actually already been rolled out for VAT registered businesses, I think, as of April 2019. So if now moving forward, to submit a VAT return, you need to have a software that Hmrc have supported, and one of those is Xero. So if you're set up on Xero, you can file your VAT returns online, and it's done. Everything's taken care of. Now, it hasn't actually been implemented yet for the income tax side of it. That's due to be rolled out, I believe, from April 2023. I'll double check it, but I think that's right. But from that stage, you again would need to have an approved software by Hmrc in place. And then you would have to be submitting everything with regards to your income tax every 3 months, I think it is. So you can imagine the information would have to be done a lot sooner. But I mean, that's 2 years away. But what we're not saying is, okay, we'll get it sorted in 2 years' time. You're better to get on board with it now, understand how it actually works, So then you're not running into problems once it kicks in for the income tax side of it, and the issues that you potentially might have. So getting it started from the get-go is something that we would recommend.
Yeah, so just to understand the difference or the change that HMRC have made is that it used to be traditionally you'd provide them with information through a self-assessment or whatever it is once a year. So they're now changing that to every 3 months. So it's becoming sort of more regular to make sure. Now the good thing is in that it smooths out the tax payments.
It does, but the good thing with the cloud software as well, it will eventually just be a click of a button. Once that time comes around, you've done everything correctly for the periods that it's involved with. So you have the 3 month period, everything looks fine. Click a button and that's it, filed, done and dusted, rather than having to take time and go over and over stuff.
Yep. Okay.
Yep.
Next slide.
Yep. Next slide.
Okay.
I think this is actually the last one. I'm nearly bang on time. So the last one then, it's more around the dates and deadlines that you need to adhere to if you're a sole trader or a limited company. So as a sole trader, the tax year runs from the 6th of April to the 5th of April every year. So the 2021-2022 tax year started there just last month from the 6th of April. The deadline then is the 5th of April, 2022. So that 12-month period is going to be what your tax year is. So everything that goes on with your business for that 12-month period is effectively going to go what is going to go on your tax return. So it's good to keep it's beneficial to keep the records correct from the get-go. And then when it comes to actually filing your tax return, the dates here and for the 31st of October 2022, that actually relates to the year 2020, 2021. So if you were trading from April 2020 to April 2021, your deadline to submit a paper tax return is the 31st of October 2022. And then for the online deadline, it's the 31st of January 2022. So any trade that you had prior to April this year, you're going to have to file a tax return for in January 2022. So it's just be mindful to keep those dates in mind when it comes to filing your tax return. And then for this tax year, it's going to be the 31st of January 2023 when your tax return is actually due to be filed. And then from that,
just so that people might be a bit concerned about those dates and things like that. But well, if you're working with an accountant will generally remind you that this is coming up and that things, they'll kind of prepare you ahead of time, as opposed to kind of contacting you on the 1st of February and saying, well, you didn't file your return. Why was that? So your accountant will keep you right in that.
Yeah, and bear in mind, I mean, they're deadlines. Well, we're not saying that it's going to be filed on the 31st of January. The aim is obviously with implementing the cloud software, you could have this submitted a lot sooner. You know exactly what your tax liability is going to be. And then you're not having to worry about pending deadlines as it gets closer to the time. So the aim is to get it done a lot sooner, provided everything is correct. And then you don't have to worry about those deadlines. From a limited company side, it's a bit different, and that you do have additional compliance to stick with in terms of filing accounts. You need to prepare company accounts, but you also need to file a company corporation tax return. The company accounts are usually run on a 12-month basis. So it's from the date you're incorporated is your first year of trading to the 12 months after. Now, there is ways of potentially reducing that first year term if you want to, but look, that's something that can be discussed later. But usually then going forward, it's a 12-month period of your accounts. And then to file your accounts, they have to be filed with Companies House 9 months after that year end. So if, for example, your year end was January, then you're going to have to file them by October of that year. And then with regards to your corporation tax is actually payable 9 months and 1 day after the year end. So they kind of go in line in terms of the filing and the payment of it. But the deadlines are pretty much the same from a corporation tax side of it and a company account side of it. And then as a limited company director, you also have to file your self-assessment if you've taken any dividends or anything from that company. And then those deadlines tie in with what we discussed there on the sole trader side of it, and the 31st of January deadline.
Yeah. Okay. So, but again, it's something that that your accounting and cloud software kind of makes easier, in the sense that, keeping you right on the deadlines and things like that. That's kind of one of the reasons why it's important. It's one less thing for you to worry about, is that your accountant can keep an eye on the dates and make sure that you're conforming okay. So I think that's everything from you, Stephen. Is that right?
Yeah, that's everything from my side.
Thanks very much for that. Just in the meantime, if anybody has any final questions before you sign off, if you want to put those into the question and answer box, and we'll try to get through them as quickly as we can. Just one question probably for you, Stephen. Somebody has asked, I receive cash in hand. Does this income need to go on my tax return?
Yeah,
it's probably a very common question.
I mean, a lot of people now, look, ideally you like to see it either transferred to your PayPal account or a bank transfer. It's probably the most easiest way to manage it. But look, every business, or most businesses these days, if they're operating kind of from a house, they'll have family and friends, neighbors, kind of close relatives that are actually paying them in cash. With cash, it's harder to keep track of, but the same goes for any income that's actually hitting your bank. You still have to declare all of that income to Hmrc on your tax return. But keeping track of it, like I said, is a lot harder. But the good thing now, it was a lot harder. Now it's much easier. With the cloud software, what you do, what you can do is to keep records of any cash income. Just issue an invoice to that client. If it's via the software, and you can, the software, it allows you to generate your own branded invoices now. So you include your own brand on it, you generate the invoice for that sale, and then that's the record for that cash income. If the invoicing is not an option for you, then you can also issue a receipt to a client, but also keep a receipt for yourself, your own record. As long as you're keeping records of that cash income, it has to be declared on your tax return. But if you have good records, then you're not going to have Hmrc coming knocking and kind of saying, look, we need evidence of all this cash income, all this income that potentially hasn't been declared. If you have good records for it, then you'll be fine.
Yeah. Okay. So it does have to be declared because it's income. It's just a slightly different way of actually keeping track of it. But again, with the right kind of way of working it, it's easy enough to keep track of. I think that's everything with regards to questions. I think we're all done, unless anybody has any more. So I think from our side, listen, thank you very much for everybody that's attended the webinar. Obviously, if you have any further questions or you want to discuss something privately, you can drop us an email, give us a call, whatever you want. A copy of the presentation will go out following the webinar, and you can also get a recording there. To book a one-to-one session, there's a link within the social media bios and things like that, or you can drop us an email or give us a call. As I said, those are free. So if it's just to kind of check something and make sure that you think something's right, but you're not entirely sure, or you're not sure what your requirements are, listen, feel free to book a consultation. We'll go through it with you. If it's more reassurance than anything, that's not a problem. But listen, finally, thanks again for attending, and feel free to follow us on social media and things like that. So if you want to just, the links are on the presentation. You can just click them there, and it'll take you to the sites. But thank you again, finally. And that's everything from us.